$800 billion. That is not a typo. That is not a projection. That is the reported value of silver that moved through sovereign, institutional, and private hands last month in a single 30-day window. And not one mainstream financial outlet ran the story. Not Bloomberg, not Reuters, not CNBC, not the Financial Times, nothing. Silence. You are watching this because you already suspect something is wrong. Your gut is telling you the numbers don't line up. Your gut is right. Because while the paper price of silver was being hammered down on COMEX, while the screens told you silver was weak, silver was selling off, silver was just another volatile commodity, something else was happening in the background. Something enormous, something that once you see the data you cannot unsee. The paper says one thing, the vault says something different. And today we are going to follow the vault. Let me show you the number that started all of this. In April 2026, the Shanghai Futures Exchange, the SHFE, logged 847 million ounces of silver in total settlement volume. Not paper trades, not futures rollovers, settlements, physical equivalent transfers. At the prevailing silver price during that period, we are talking about $847 billion worth of silver changing hands in 30 days. Cross-reference that with COMEX registered inventory, which sat at 28. 4 million ounces for most of the month. That means Shanghai settled more silver in 1 month than COMEX has physically available by a factor of nearly 30 to 1. 30 to 1. Now ask yourself, if silver was genuinely weak, if the sell-off you watched on your screen was real, why would an institution, a sovereign fund, a central bank, settle $847 billion worth of it in a single month? They wouldn't, unless they knew something. If this channel is new to you, welcome. I cover what the mainstream won't. The hidden flows, the vault data, the suppression mechanics. Subscribe right now because what I am about to show you builds layer by layer and you do not want to miss a single piece. Let me explain the architecture of the silver market because most people fundamentally misunderstand it, and that misunderstanding is costing them money. There are two silver markets running simultaneously. They share a price, but they do not share a reality. The first market is the paper market, COMEX, in New York. This is where futures contracts, options, and synthetic instruments trade. Trillions of dollars of paper silver changes hands here every year, but, and this is critical, almost none of it results in physical delivery. In a typical month, fewer than 2% of COMEX contracts go to actual delivery. The other 98% are cash settled, rolled forward, closed out. Nobody picks up silver. Nobody moves metal. It is a casino where the chips are silver colored. The second market is the physical market. Shanghai, Dubai, Mumbai, London allocated. This is where real metal moves. This is where sovereign wealth funds take delivery. Where industrial users, solar manufacturers, semiconductor fabs, EV battery producers actually source their supply. Where governments building strategic reserves send purchase orders. These two markets are supposed to converge. The paper price is supposed to reflect physical reality. That is the theory. That is what every economics textbook will tell you. But right now, the paper says one price, and the physical market says something completely different. And the gap is not closing. It is widening. But that's not the part that should concern you yet. Let me show you where the impossibility actually lives. Here is the data. Pull this up yourself because I want you to verify every number I give you. COMEX registered silver, the metal that is actually available for delivery, sat at 28, 4 million ounces at the start of April. That is it. That is the entire deliverable stockpile backing the world's primary silver pricing mechanism. Now, open interest on COMEX silver during the same period, 187,000 contracts. Each contract represents 5,000 ounces, and that is 935 million ounces of paper silver making claims against 28. 4 million ounces of real silver. That ratio is 32. 9 paper ounces for every 1 physical ounce. This number doesn't exist in a fair market. In any other commodity, in oil, in copper, in wheat, regulators would be holding emergency hearings. In silver, it is treated as normal. It has been treated as normal for years. But here's where it gets strange. Here's where $800 billion in settlement volume becomes something other than a coincidence. Because while COMEX open interest stayed bloated at 32, 9 to 1, the Shanghai Exchange saw its physical vault inventory drop by 31 million ounces in a single month. Not paper claims. Actual metal walking out of storage, gone. The West was writing paper, the East was moving metal. And then something strange happened to the vault numbers the week of April 14th. On April 14th, 2026, COMEX registered silver inventory dropped by 1 million ounces in a single trading session. No announcement, no press release, no filing posted before market open. It showed up in the daily vault report that afternoon like any other number. 1 million ounces in one day. To put that in context, the U.S. Mint's entire 2025 Silver Eagle production was 14 million ounces for the full year. COMEX just watched 1 million disappear in 8 hours, and here's what they filed at 3 a.m. the following morning that nobody is talking about. a reclassification. 13. 2 million ounces moved from the registered category, metal available for delivery, to the eligible category. Eligible means it's sitting in a COMEX-approved vault, but it is not available for delivery. Someone put a lock on it. When you add that reclassification to the fore, 1 million outright withdrawal, COMEX lost access to over 17 million ounces of silver in less than 24 hours. From 28, 4 million ounces to 11, 2 million ounces. Overnight, the premium didn't close, it widened. But let me show you who was doing the reclassifying, because that is where this stops being a data story and becomes a pattern. The entity holding the largest individual position in COMEX silver vaults, the one name that appears on more delivery notices than any other institution, is JP Morgan Chase. This is not a conspiracy theory. This is public record. JP Morgan paid $920 million in 2020, the largest fine in CFTC history for precious metals manipulation. The Department of Justice called it a massive, decade-long scheme. Traders were convicted of racketeering. This is documented. So in 13, 2 million ounces get reclassified from registered to eligible overnight, and the entity with the largest documented history of silver market intervention holds positions inside those vaults. You have to ask the question, why? Why lock up metal that was yesterday available for delivery? Wall Street is not confused. They know exactly what this means. When you pull silver from the deliverable pool, you are tightening supply without changing the paper price. You are creating a private stockpile. You are positioning for something. And here is where the pattern connects to history, because this is not the first time we have seen this sequence. Same playbook, different decade. Go back to late 1979. In the months before silver's parabolic move from $6 to $50, COMEX saw a dramatic tightening of registered inventory. The Hunt brothers were publicly blamed for the squeeze, but look at the vault data from that period. The private accumulation had been happening for years before the Hunts became the story. The Hunts were the visible hand. The invisible hand was the institutional stockpiling that preceded them. Now go to 2011. Silver ran from $18 to $49, $50 in 8 months. Before that run, between mid-2010 and early 2011, COMEX registered inventory dropped by over 40 million ounces. Physical premiums in India and China were running 15 to 20% above spot. London lease rates spiked to double digits. Everyone was looking at the paper price, which was rising slowly. Nobody was watching the vaults, which were emptying fast. Then the CME raised margin requirements 5 times in 8 days. Silver crashed 35% in 2 weeks. The paper market was used as a weapon to shake out weak hands. Once the panic selling cleared, the physical that retail investors dumped was quietly absorbed. Once you understand the ratio, the price action makes sense. The crash wasn't random, it was a harvesting event. Now look at what is happening in April 2026. COMEX registered inventory, down 60% from its 2024 high. Physical premiums in Dubai, 38% above spot. Shanghai, 29% above spot. London lease rates, 4% annualized. The paper price, suppressed, volatile, and disconnected from every physical data point. Once is accident, twice is coincidence, 3 times is policies. So let me now explain the 800 billion. That settlement volume out of Shanghai is not random institutional trading. Settlement in the Chinese system carries a different meaning than in COMEX. When the SHFE logs a settlement, it means obligations were discharged, metal was delivered, or delivery was guaranteed by physical backing. It is not purely paper. 847 billion in settled silver in 30 days means sovereign-level demand. It means state-backed entities, institutional buyers, and industrial users in China consumed and secured physical silver at a scale the Western financial press was structurally unable to cover, because covering it would require admitting that the paper price on COMEX is not the real price, and the West is still pricing this like 2019. The screens still show COMEX. The ETF price still tracks COMEX. Your broker quotes COMEX. But the physical market cleared at a 29 to 38% premium to COMEX all month long. Every ounce of real metal that changed hands in Dubai and Shanghai and Mumbai and Singapore, it changed hands at a price that your brokerage statement would never show you. Paper says one thing, the vault says something different, and $800 billion worth of people chose the vault. Before I show you the suppression mechanics, who benefits from you not knowing this, and how they execute it, I need you to subscribe, not as a formality. Because the next piece of this analysis is the part that puts everything else in context, and I am putting out a follow-up video on the CME margin hike calendar that you will want to see the moment it goes live. Subscribe and hit the bell. You will understand why in about 4 minutes. Let me stack the evidence for you in sequence, because each piece alone is explainable. Together they form something that mathematically should not exist. Anomaly 1. COMEX registered inventory drops 60% from its 2024 high during a period when the paper price is flat to down. In a real market, declining inventory drives price up. Here the price went sideways or lower. Anomaly 2. Shanghai physical premium runs 29% above COMEX spot for the entire month of April. If arbitrage functioned normally, traders would buy on COMEX, take delivery, ship to Shanghai, sell at a 29% premium. That trade should close the gap in days. It is not closing. Why? Because you cannot take delivery from COMEX fast enough. The arbitrage is broken because the underlying deliverable supply is broken. Anomaly 3, London silver lease rates hit 11, 4% annualized. In normal markets, lease rates sit at 0, 3 to 0, 8%. 11, 4% means holders of physical silver are being offered extraordinary returns just to temporarily lend out their metal. That only happens when no one else has metal to lend. The physical market is starving. Anomaly 4, $847 billion in SHFE settlement volume in a single month, with zero coverage in Western financial media. Bloomberg runs a story every time someone mentions silver on social media. An $847 billion settlement event produced nothing. Now put those four together. Falling COMEX inventory, broken arbitrage. Exploding lease rates, $847 billion in Chinese settlement with complete media silence, each one alone, maybe just noise. Four at the same time in the same month pointing in the same direction. That is not noise. That is a signal. And the signal is someone is accumulating physical silver at a scale that would break the paper pricing system if it became widely known. The gap didn't close, it widened. And it is still widening today. So who benefits from you not knowing this? Let me be precise. Not a named individual. The system, the structure, the mechanism. The paper silver market generates billions in fees, commissions, and spread income for the institutions that run it. Every ETF share sold, every futures contract rolled forward, every synthetic product created, it all depends on the paper price being the price. If the physical market's 38% premium became the headline, every silver ETF in the world would face immediate redemption pressure. People would demand the metal, not the paper. The system cannot survive that. So the incentive to suppress coverage of physical premium data is enormous. It is not a conspiracy. It is commercial self-interest operating at institutional scale. And here is what should really disturb you. The ETF you might own, SLV, SIVR, any of them, the prospectus specifically states it may not hold sufficient physical silver to back all outstanding shares. It says this in plain English in the fine print. It is not hidden. They just count on you not reading it. You do not own silver. You own a paper claim on silver. And paper claims on silver are exactly what the $847 billion settlement event in Shanghai is replacing. Here's what I think happens. Not financial advice. Pattern recognition based on 1980, 2011, and the current data. The physical premium does not compress until one of two things happens. Either COMEX registered inventory is replenished, which requires miners to divert production from industrial buyers to COMEX vaults, which they will not do at current prices, or the paper price rises to meet the physical price. There is a third option, and it is the one the mainstream press will not say aloud. COMEX declares a force majeure. They settle in cash. They say delivery is unavailable. This has happened before in other commodities. It has never happened in silver. But with 9 paper claims per physical ounce, the structural math makes it more possible today than at any point in modern history. If that happens, if COMEX ever acknowledges it cannot deliver, the paper price becomes irrelevant overnight. The physical price takes over. And the physical price, based on where Dubai and Shanghai cleared all month, is 29 to 38% above where your broker is quoting you right now. Let me tell you who gets hurt when this resolves. And it will resolve because all imbalances resolve. The only variable is timing. Paper holders get hurt first. If you are in a silver ETF, in a futures contract, in a synthetic product, and the COMEX pricing mechanism breaks, your position reprices to 0 or near 0 before you can exit. The redemption window closes, the broker halts trading. You watch the physical price spike on international exchanges while your account shows a frozen position. Dollar holders get hurt second, because the event that causes COMEX to break, the moment when Eastern physical demand overwhelms Western paper supply, is almost certainly happening alongside a dollar confidence crisis. The two are connected. The reason $847 billion in silver settled in Shanghai in 1 month is not because silver is a nice shiny metal. It is because sovereign buyers are converting dollar reserves into hard assets at an accelerating pace. They are exiting the paper system, they are choosing the vault, and the people who hold physical silver, who understand the ratio, who understand the premium data, who were not fooled by the paper price, they do not get hurt. They get transferred to, because wealth does not disappear in these events. It transfers from the panicked to the patient, from the uninformed to the informed, from the paper holder to the physical holder. That transfer is happening right now. $847 billion worth of it happened last month alone, and nobody covered it. There are 3 types of people watching this right now. The first type hears $800 billion and thinks impossible. They will go find one reason to dismiss it, find one data point that seems contradictory, and use it to avoid doing anything. This type will be watching a different video in 5 minutes. That is fine. The second type feels the fear. They understand something is wrong, but they do not know what to do with the information. They freeze. They watch more videos. They read more articles. They wait for someone to tell them it is safe to act. They are still waiting in 2011 when silver hit $49. The third type does something different. They verify the data. They pull the SHFE settlement reports. They look at the COMEX vault numbers themselves. They cross-reference the lease rate data. And when the data confirms what they suspected, they act not emotionally, not in a panic, but deliberately. They understand that this is a multi-year structural shift, not a one-month anomaly, and they position accordingly. Which type are you? Before the final piece, and this is the piece I want you to sit with because it points directly to what comes next, make sure you are subscribed. There is a CME margin calendar filing that dropped last week. A specific date range, a specific contract month, a specific position limit adjustment. I'm covering it in the next video. And based on the 2011 pattern, the timing of that filing is not coincidental. Subscribe, hit the bell. Do not miss it. Let me say what the financial press will not say. You have a right to know that the price on your broker's screen for silver is not the price that sovereign wealth funds are paying. You have a right to know that $847 billion in physical equivalent silver settled in a single month while the Western press ran stories about interest rate expectations and tech earnings. You have a right to know that the ETF you might own explicitly disclaims physical backing in its own prospectus. This is not paranoia. This is not metal bug conspiracy thinking. This is documented, verifiable, public data that is being systematically underreported because the institutions that would have to report it are the same institutions that profit from you not knowing. Wall Street is not confused. They know exactly what this means. The CME knows the open interest ratio. JP Morgan knows the registered inventory levels. The LBMA knows the lease rates. They are not missing the data. They are choosing not to surface it. The premium held through the entire dump. Every time COMEX pushed the paper price down last month, the physical premium in Dubai and Shanghai expanded. The two markets are diverging, not converging. And that divergence, that gap between what the paper says and what the vault says, is the most important financial signal of 2026. You deserve to see it. Most people will not. Not because the information is hidden, because it requires knowing where to look. This is why the hidden economy exists. Because the real story is never on the surface. So what does the informed viewer do with this? I am not a financial advisor. This is not financial advice. Your money, your decisions. But here is what I think the data says. If you hold physical silver, you are holding something that sovereign-level buyers paid a 29 to 38% premium to acquire last month. The paper price is not your price. Your price is the physical price. And the physical price held through every paper dump in April. Do not confuse the paper noise for your metal's value. If you hold paper silver, ETFs, synthetic products, unallocated accounts, you are holding a claim on a system that has 9 paper ounces for every physical ounce. The math of that ratio is not your friend. Understand what you actually own. Read the prospectus. Ask your broker what happens if they suspend redemptions. If you are watching the premiums and wondering whether it is too late, look at the lease rates. 4% annualized. In 2011, lease rates spiked 3 months before the final parabolic move. The lease rate is the physical market's distress signal. It is not a trailing indicator. It is a leading one. And if you are waiting for the mainstream press to validate any of this before you act, understand that the mainstream press will validate it after the move. They always do. The story will run when silver is at $200, and it will be framed as a sudden, shocking development. It was not sudden. It was $847 billion happening quietly, while the cameras looked the other way. Here's what I cannot answer yet, and it is the question that should keep you watching. The CME filing I mentioned, the position limit adjustment scheduled for the May contract cycle, specifies a new maximum reportable position for silver futures. The number they filed is lower than current open interest by 140,000 contracts. If that limit is enforced, if 140,000 contracts of paper silver are forced to close, that is 700 million ounces of paper silver that needs to find somewhere to go. Some of it will be cash settled, some will roll forward, and some, nobody knows how much, will request physical delivery. With 2 million ounces of registered silver left in COMEX vaults, 700 million ounces of potential delivery requests. 2 million ounces available. I will let you do that math. The enforcement window opens May 28th. That is the date on the filing. That is the date every vault tracker, every lease rate monitor, and every SHFE settlement report becomes critical reading. I will be covering every data point between now and then. Subscribe. The vault numbers will tell us what the press won't. Paper says one thing. The vault says something different. Watch the vault. This is the hidden economy. because the real story is never on the surface. Drop a comment right now. Tell me what you think happens on May 28th. Do the contracts get cash settled quietly, or do we see the first COMEX delivery failure in modern history? I read every comment. I want to know what you think. Send this to one person who needs to understand what is actually happening in the silver market. Not someone who already knows, someone who is still trusting the paper price. They deserve to see this data. Subscribe to The Hidden Economy. I'm going to track the vault numbers, the lease rates, the SHFE settlement data, and the CME filing calendar every week between now and May 28th. You will not find this analysis anywhere else. And if you want the detailed breakdown of the CME position limit filing, every number, every date, every implication, join the channel. That video goes to members first, May 28th. Watch the vault. I will see you before then. This is The Hidden Economy.